Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review something we call thin air real estate principles. Essentially, how to create money or wealth out of thin air, right? And so I have this mentor who's not like a direct mentor of mine, but I've seen him speak many, many times. So he's an indirect mentor, I guess you could say. And one of the things that he would always say, and to the point I've gotten sick of it, and to the point I've gotten brainwashed by it. But he would always say every time I hear speak, the easiest way to create wealth out of thin air with real estate is essentially buy it at a discount. I've heard that a billion times. Like buy it at a discount. You have to buy it at a discount. You buy real estate at a discount. You're creating wealth out of thin air, right? And so I'll give you a quick example of what I mean by this. And so this is a property that we bought. You can see the Zestimate is 330. Now I get the Zestimate is not always accurate, but if the Zestimate says it's 330 and we bought it for about 210, we got a pretty significant discount, right? So we got a pretty significant discount, and because we bought it at a discount, we created wealth out of thin air. Now, the other thing too is that after having learned velocity banking, I realized, wow, this is another way that we can create money or cash flow out of thin air, right? So if you don't know what I mean by that, I'm going to go into a spreadsheet, kind of give you an idea like, hey, if you needed an extra $100 but didn't have it before because you were paycheck to paycheck, I'm going to show you how to kind of create that cash flow that you can use out of thin air. Okay, so let's get to it. And here's the other thing: if you combine these two principles of creating money out of thin air, oh, you are going to be on the good path, right? You're headed for good times. Now, let's go to our spreadsheets here. So whenever we're doing velocity banking, we essentially have to do two things. And I always say this over and over again, and I want to say it until you're sick of it. Just like I'm sick of hearing buy assets at a discount, but because I'm so sick of it, the message is ingrained in me. First thing we have to do is we have to create a budget, right? So here we have what we call the average American. So we're just assume this person is paycheck to paycheck, okay? So maybe they make a pretty decent income, $5,000 after taxes, $5,000 in expenses, zero in savings, zero in cash flow, and then we have a student loan. So here's the thing: after you do your budget and you have your expenses, then you do an expense breakdown, right? So what's important when we're doing expense breakdown is that every single a loan or debt that we have is its line item year, because every debt represents cash flow that we need to recover. Okay, so we have a student loan for $400 a month, car loan for 600. Actually, let me go ahead and copy and paste the formatting here. Okay, so let me delete that. So 400 a month, 600 for the car loan, and these are based on average figures, right? Rent, we're gonna say is $2,000 a month, and other food, gas, all the other good stuff is about $2,000 a month. And so if you add this up, 4,000, 1,000, that's essentially a $5,000 expenses. So this person is living paycheck to paycheck. So think about this. In this situation, if you ever needed a dollar extra, right, $1 extra, where are you going to get it? You can't. If you wanted a $1 candy bar or $1, I don't know, something from the grocery store, beef jerky, can you really get it? No, you can't get it. And here's the thing too, like let's say you really, really wanted it, then what would you need? You need a credit card, right? So we'll just call it beef jerky. Beef jerky, and we'll say it costs us not 2,000, we'll say it costs us $1, right? And so when we're in this situation, our expenses turn to $5,001, and then now we're in negative $1 cash flow, right? And in this scenario, we're not going to win. We're not going to win. We're in a negative cash flow scenario. So what can we do to magically generate cash flow or money we can use out of thin air, right? And that's where velocity banking comes in. So let me go ahead and reset this $5,000. Actually, one other thing too, if we really wanted the beef jerky, what is something that we can do if we don't use velocity banking? Well, we could put it on a credit card. So why don't I just put this beef jerky on a credit card, right? So we can really get it because we want to go $1 over our budget. And so if we do that, again, we're a negative $1 cash flow. So something's got to give. Am I not going to pay the credit card? Am I going to pay the car loan $599? Am I going to pay the student loan $399? So if whatever happens in this situation, either I shortchange the rent by $1 and I might get an eviction, shortchange the car loan by $1 and then I'll get something bad on my credit report. Shortchange the student loan by $1, same thing. I might have a derogatory in my credit report or a late payment, or I don't pay the credit card that $1 and then that'll ruin my credit, right? And then the other sacrifices are going to be in the food, gas, insurance, and other things. So if we're going to sacrifice other things in life, I guess that's what we'll have to make it. And I think it's happening with a lot of Americans these days. But as you can see here, just the fact that we're a negative $1 cash flow, and even if we had a credit card as a backup, that doesn't really put us in a good situation, right? So let's see how velocity banking can help us. And so we're going to reset this here. And now we're going to have an extra column for velocity banking, right? And so what we're going to do is we need to do a budget, okay? We need to do a budget. We're going to hold on to our expenses because we're going to change a little bit of our behavior. And when we do velocity banking, we're going to put 0 checking and savings, okay? And then actually, let me go ahead and copy and paste this. Okay, so 0 in our checking and savings, and then we're going to modify our behavior so that we can create additional cash flow. Okay, so we're definitely going to do that. So if you don't know the velocity banking strategy, and one of the things I always say, okay, first, if you have no idea what I'm talking about, go ahead and click the velocity banking 101 link below. Come back to get view the video, get a foundation, and come back here to continue your studies, right? But if you already know the concept, then I'm just going to review it for you. Basically, what you do is you put your entire paycheck in something we call a line of credit, right? So if you know what a credit card is, that's essentially a line of credit. All it is a financial tool where you can pay you basically can borrow money, pay it back, and reuse it over and over again. So credit card is a line of credit. And I'm going to briefly go into that. So we have our paycheck, $5,000. We're going to put it into something called a line of credit, and then we're going to take out our expenses from there, and then rinse and repeat. Okay? So now what we have to do is we have to choose our line of credit, which will be our main operating account. So there's different types of lines of credit. There's personal, business, home equity line of credit. But I'm going to say that we have a $25,000 personal line of credit. And so maybe one of the banks that you talked to or credit union said, hey, we'll let you use our money, right, at up to $25,000 at a 15% interest rate. And so if you don't know how a line of credit works or a personal line of credit, basically you just click a button on the bank's website for the most part, and then they'll give you pretty much mostly up to most of the balance. Maybe they have like a $10,000 withdrawal limit per day. I know some do, but let's just assume that if you click a button on a website, then up to $25,000 can be withdrawn and it'll be in your checking account. Okay, so now that we know the strategy, let's just kind of modify our behaviors, just do a few simple changes to free up cash flow and create it essentially out of thin air. Okay, so here's the thing. We haven't used this credit balance yet, or line of credit yet. So what's a way that we can use it and also free up some cash flow? Well, I see these two loans right here. We have a student loan and a car loan. So what I can do is if we move these balances, so $10,000, $13,000 here, we're going to free up $1,000 of cash flow. So why don't we just eliminate these debts right now, right? So before we're living paycheck to paycheck, right? And if we needed an extra dollar in expense, beef jerky, that was going to go on a credit card if we really, 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 really wanted it. And we knew exactly what our numbers were. And then that would have put us in an awful situation. Now, the difference between this situation and this situation, the velocity banking situation, is that we did not use, the average American did not use the line of credit or the credit card as the main operating account, right? But with velocity banking, we have to use our credit card or our line of credit as the main operating account, okay? So like I said before, we're going to eliminate these two loans. Let's go here, 23,000. And what happens when we move the balances of the loans to line of credit? This goes to 0. And I'm going to copy the formatting. Okay, so this goes to 0, right? This goes to 0. And look at this. Our expenses magically went down by $1,000, right? So you add this up, and now we have $1,000 of cash flow, right? So think about that. All we didn't create extra income, but we created extra cash flow out of thin air, right? Where'd the $1,000 come from? I don't know. But all I know is that if I transfer this $5,000 to the balance of the line of credit, normally most Americans consider the payment of a line of credit as an expense, but when we're using it as our main operating account, it really doesn't matter because you're satisfying the minimum monthly payment and the interest will be at its lowest when you transfer your entire paycheck to the line of credit. And then eventually the expenses will creep up by 4,000. So if this will go down 5,000. The balance will eventually go up 4,000. And so the next month, the balance will approximately be 22,000. So we'll go down. So let me just do a calculation for this by $1,000. So again, this is an approximate, right? I know it's an approximation. And I also know that you have to add interest, but we're going to make the calculation simple and easy to understand. So there's going to be a little bit of inaccuracy, but it's not going to be that much of a big deviation from the most accurate numbers. Okay, so now let's just figure out how long it took us to pay off this line of credit. So what we do is we just take J2 and then we just add 1 and then we copy and paste this formula. So let's go to here. So it's going to take us about almost under a year. So 2 years, 24 months is 2 years. So a little bit under 2 years it's going to take us to pay off the line of credit. And so now what we're going to do is calculate the interest, okay? So every time we use OPM, other people's money or the bank's money, they're not going to allow us to borrow the money for free unless we're in an introductory period. They're going to charge us. So how do we calculate or approximate the interest from in the line of credit? Basically what we do is we take the previous month's balance, multiply it by the interest rate, and then divide by 12, okay? So equals H2 times 15%, that's 0.15, and then we divide by 12. Why divide by 12? Interest rates are quoted annually, and so we want the monthly interest rate. And I always say this is actually technically wrong because the interest is actually calculated daily, but we don't know what the average daily balance is going to be because we don't know when the expenses are going to occur, right? If we knew when the expenses are going to occur, it'd be much easier, but this is good enough, okay? So now let's go ahead and sum up the interest. So it's really easy. And we're going to go ahead and sum that up. And so basically we paid this under 2 years. We had to pay about $3,450 in interest. If you want to add this to, now I know that in general, this is actually added to the balance, but for the sake of simplicity's sake, we did not do that because I just want to show you approximately, like just make the calculations easier for the interest. Now, if you want to just kind of add it back to here at the end, and then just kind of apply a couple months worth of cash flow, you certainly can do that. But just be aware that you would pay about $3,400 in interest when doing this method. Now, that's not the main point I want to make in this video. The main point I want to make is this video about creating money or wealth or cash flow out of thin air, right? So in this scenario that we talked about for the average American, when we needed $1 extra, no matter what we did, we'd actually be screwed in the paycheck to paycheck scenario. But take a look at this, right? So let's say I put my entire paycheck here, take out my expenses here. Now, if I ever needed an extra dollar at any point in this process, can I get it? Yes, I can. Now, will emergencies happen? Absolutely. Maybe even have $1,000 emergency. And so the balance of the line of credit will essentially be the same from 1 month to another. Okay, whoop-de-doo, you added another month. But this gives you so much more flexibility and power and control rather than just using your checking account as your main operating account, right? You use your checking account as your main operating account, you have no power, you have no control, you have no liquidity. You can't just generate cash flow out of thin air like this $1,000 that we did in the velocity banking scenario. Again, the only difference between velocity banking and the average American scenario is what are you using as your main operating account? Is it your checking account or is it your line of credit? Here, we're going to make sure that our line of credit is the main operating account. And then about every month or so, it's going to go out actually $1,000, mine plus this interest. So it's not going to actually go down $1,000, but we're just going to say it does, down, 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 down. And then we have so much more control and flexibility over how we spend our money. Whereas in this scenario, we have no wiggle room. We need to be very disciplined that we don't spend more than $1 more than we make. Whereas here, I love to use velocity banking because yes, we need cash flow, but I don't have to be exact in my numbers and expenses. I can just approximate them. And I know when I look at my bank statements or my credit card statements or loan statements every month, I notice it's going down by a significant portion. In fact, I did a calculation where 2 months ago I was about $90,000 in revolving credit debt, and then magically, like the next month, I think I'm like 70,000 or something like that. But yeah, so this is essentially how velocity banking will create money or cash flow out of thin air. And again, if you combine these two principles where you buy assets at a discount like this, right? You get cash flow from buying an asset at a discount, and you're able to apply velocity banking, sky's the limit, right? There's essentially no limit to what you can do, and that's actually what I'm doing right now. Okay, so I'm always going to make a plug for our group. So at the end, so here's the thing. There's going to be a link below to Google Form link. Go ahead and click it, and just put in something about yourself, your basic information. Say you're interested in joining the group, and so if you want to do that, go ahead and do that. And also, if you want to go ahead and email us, have any questions, there's our if you go to the about page of the YouTube channel, go ahead and click that link, and you can find our, well, not the link, but you can go ahead and find out our email address and then email us from there. Okay, so this is Korean Atlanta Mentorship. Have a great day, everybody, and we will speak next time.